the San Francisco Fed President, Mary Daly. She has been there since 2019, but her career is a long-standing career at the San Francisco Fed. She's one of the few regional Fed presidents that really, from the district. She's a San Francisco person. And she has also, one of the most incredible backgrounds, brings to us a really unique perspective that is so valuable and unfortunately still not common enough in economics, and has been a champion in the organization of the San Francisco Fed, fostering diversity and inclusion in the staff and making sure that pipeline, looks the way it should look. So, and by the way, she's also a really great economist, fantastic labor economist. I know for years I've been reading her work, even well before she became San Francisco Fed president. So we're looking forward to some insights from her today. She's going to give us some remarks, and then we're going to do some Q&A. So use your app, submit some questions, and I promise I will get to as many as I can. Please join me in welcoming Mary Daly.
So the first thing I want to say is thank you. And I got to type in my password. Apparently it's been password protected. The Fed is a very, very rigorous security system. Okay, there we go. So thank you so much for the nice introduction. It's great to see everybody here. I have to say, and I didn't plan this, and I'm certainly not paid by the NABE Foundation or any of the NABE people, but one of the things that I was struck by when I walked into the conference this morning was how many young people I saw and how diverse those young people were. So the future of economics is bright. I feel really good about it, and I appreciate everyone at NABE who has been driving this forward. It's a help to the Federal Reserve System, and I think it's just a general help to the profession. So thank you. So I'm going to give a few remarks before we get started, and they're really meant to sort of set the stage for some of the discussion that I look forward to having. I want to start with a story. The day after the December FOMC meeting, so just a few months ago, a man came up to me in the dry cleaner. He told me that he and his wife had gone out to dinner the night before, right after the chair's press conference. They went partly to celebrate the end of the Fed's tightening cycle, but mostly, and this is the really important part, mostly to mark the end of a long, hard battle to bring inflation down, which they had felt they'd directly been in. He thought that the worst was behind us and that he and his family could finally take a breath. Now, the relief he described is actually not unique. I hear it everywhere I travel. I have the whole Western United States, 9 states, and I travel across the country. And what I hear is businesses, communities, and families exhaling just a bit as they see inflation falling without the economy breaking. There is no doubt that things are better. But progress is not victory. And we, the FOMC, need to deliver more than fleeting moments of relief. Our goals are sustainable, and I want to underline sustainable. Sustainable price stability and full employment, working together in a balance that is going to last. And there is more work to do to deliver on this commitment. So today, I'm going to discuss the progress we've made, the risks we face in continued progress, and what we're going to need to do to finish the job. But as always, if you've been to many of talks by Fed officials, I will remind you that the views I express are my own and do not necessarily reflect those of my colleagues. So let's start with progress. So relative to a year ago, the economy is in a very good place. Inflation is heading down, the labor market is rebalancing, and many of the post-pandemic disruptions are dissipating. The inflation progress has been fairly remarkable. In the latest PCE inflation release, prices were up just 2.6% compared to a year ago. And that's still not price stability, but it's a far cry from 7.1%, which we hit in June of 2022. And a big part of the story on inflation has been supply. Global production, warehousing, and distribution networks have largely returned to normal. Very good news. And bottlenecks, wait times, and price pressures have followed. Now, these things aren't surprising. We've been waiting for them, and now they finally happened. And they've helped goods price inflation come down substantially so that it's now near its pre-pandemic level. The surprise, if you will, on the supply side has been the positive news on labor and productivity. Defying all the pessimists, perhaps somewhere in this room, US workers in the prime of their working age came back to work last year, including women and mothers. And that's good news for the economy. This drove prime age participation to its highest level in 2 decades. At the same time, we saw a surge in immigration. And both of these developments boosted labor availability, just the sheer number of workers that wanted to work. But we didn't just get more workers. These workers actually became more productive. Productivity growth picked up notably last year, surpassing its pre-pandemic trend. If you put these together, supply developments eased labor market tightness and helped bring wage inflation closer to a level consistent with our 2% inflation target. And that's a lot of good news. But to my mind, the best news is that the decline in inflation hasn't just been about supply. Improvements also have come from the gradual slowing of demand, the portion that monetary policy directly affects. Now, we hear this demand-driven story from our contacts, and we see it in surveys, but we can also quantify it. And San Francisco researchers have developed an analysis meant to do this. They focus on the PCE index, and they separate individual price changes of individual items in the index into those driven by demand, where prices and quantities move in the same direction, and those driven by supply, where prices and quantities move in opposite directions. And their analysis shows that about 2/3 of the decline in core PCE inflation in 2023 came from the demand side. That's a big number. Demand did play less of a role in headline PCE because supplies of food and energy always drive those dynamics on inflation more than demand factors. But demand played a large role in the core, and that's very good news. So if you put all of this together, the supply factors and the demand factors I just described, it is clear that things changed in 2023. The dynamic we want started to occur. Supply bounced back, tighter monetary policy gained traction, and inflation came down rapidly. And for households and businesses, the treadmill of persistently high and rising inflation slowed down. And all of this came without a significant decline in growth or employment. It's unequivocally good news, and it is progress, and it does provide some relief. But the question is, and this is where everybody is today, is should we expect this progress to continue? Well, if you look at the modal outlook of many professional forecasters, the answer seems to be yes. The meeting of the December SEP done by us at the FOMC portrayed a similar view. But most striking, perhaps, is the confidence that households, businesses, and markets show in surveys on continued progress and in markets from financial conditions. Among households, once elevated year-ahead inflation expectations have fallen substantially and are now near their pre-pandemic levels. So this has been an area where short-term inflation expectations of households rose rapidly. So now they've come back down to near pre-pandemic levels, and that's good news. And that's true in both the Michigan Fed and the New York Fed surveys. Business inflation expectations have also improved. According to the Atlanta Fed Inflation Project, businesses see prices in the coming year rising just slightly above 2%. That's about the norm for that series. And as I mentioned, financial markets have similar expectations. Inflation around 2% by the end of this year. But this is where it gets challenging. Projections and expectations are just that. views about what we think will happen 12 months from now. We need more time and data to be sure that they are on the path to be realized. And we need to monitor risks along the way that could just delay the progress that we want to see. And this is especially true now. It's always true, but it's especially true now when uncertainty is so high. I know that's a topic you've talked about at the conference. There's a lot of uncertainty out there. So there's a myriad of risks that we can consider, and I think you have talked about many of them at the conference, but I want to focus on two: slower progress on inflation and fragilities in the labor market. So on inflation, there is a risk that the positive supply developments we saw last year might be hard to sustain. Labor force participation for prime age workers is close to historical highs. And with the labor market cooling and wage gains slowing, we might not see additional outsized increases or contributions coming from that group. We also might see a slowdown in the large influx of foreign-born workers, which would further limit labor force growth. Now, I always bet on workers and the interest people have in participating in the economy, but at this point, further gains in that space are hard to predict, and that does pose a risk to continued declines or rapid declines in inflation. The same can be said of productivity growth. It's highly uncertain whether we will continue to see the gains we saw last year. There are many reasons to be optimistic, and I tend to be optimistic in these spaces, but productivity trends are notoriously hard to forecast. And just can't be sure of what the future holds at this point, so we have to watch and wait. And of course, we live in a dynamic world, and there are always new shocks, like disruptions in the Red Sea and Panama Canal to disrupt supply, make it go down instead of up like we'd want. And I know this was a concern in the NABE survey. Both of those could factor in to both limit supply and interrupt goods distribution and push up prices. Right now, we're not seeing a lot of that, but we definitely have to keep it in the risk set for what could happen. On the demand side, momentum remains a risk, especially among consumers. So if you put aside yesterday's retail sales numbers, we repeatedly expect spending to slow, only to be wrong. I think we can even use the word wrong because we just keep expecting it. And this is the royal we, probably everybody in this room and most of us at the Fed. You just think that consumers are going to slow down a bit, but they just don't. So that's a risk on momentum. And if economic momentum in the economy outstrips available supply, well, then that's a risk, an upward risk on inflation. But this year is a little bit different than last year in this regard. The risks on both sides of our mandate are now more balanced. And that means that slower progress on inflation isn't the only risk we face. On the other side of our mandate, the labor market could falter. Now, I want to be really clear. Right now, I don't see any evidence that that's occurring. So far, labor market conditions have eased without a rise in unemployment. In technical terms, we've been sliding down the steep portion of the beverage curve, where changes in labor demand reduce vacancies without reducing jobs and pushing up unemployment. But as the vacancy rate gets closer and closer to its pre-pandemic average, these favorable conditions could end. And then the trade-off between falling labor demand and unemployment could be more stark. Of course, as I said, with employment growth as strong as it's been, this seems like a distant risk sitting right here. But given the speed at which the labor market pivots historically occur, it's a risk we must keep in mind. So that's the landscape. The economy is healthy, price stability is within sight, and there is more work to do. To finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed and be prepared to respond agilely as the economy evolves. But this is not a new situation for the Fed or for any central bank. Uncertainty is a fact of life, and the economy rarely signals exactly where it is headed. The constant in our ever-changing environment is our goals. And they are always sustainable price stability, and full employment for a healthy economy. Now, when I say that, many people say, yes, that's what the Fed often reports. But these are more than just words. And I'm reminded of that fact every day. So I want to go back to the dry cleaner. So after the dry cleaner last December, I went to the hardware store. And I was standing in line behind a dad and his college-age daughter. When the total rang up for their purchases, the dad asked the cashier why it was so high. And without a single moment of hesitation, the cashier said, inflation, everything costs more. Now, as the two walked out, the daughter asked her dad, or said to her dad, I never heard much about inflation before the pandemic. And her father responded, and I hope you never do again. That is really what we're after, an economy that is consistently unburdened by inflation, where people can step off the treadmill of ever-rising prices and make decisions about their lives and livelihoods. We want price stability that is built to last. Thank you.
Okay. So now we get to have a conversation. Thank you very much. That was uplifting. It's unusual. I'm going to have to get used to maybe some more optimistic speeches.
Well,
from
I'm an evidence-based optimist, so the evidence is creating some optimism right now.
It is, and you reviewed some of the very favorable developments we've had over the past year. So why don't we start with some of the sort of messier data we've gotten at the start of the year?
Sure.
We had an employment report. Jobs were strong, but hours were weak. CPI inflation stronger than expected. Retail sales fell. Housing starts fell this morning, but confidence surged. So what do you make of all of this? This is sort of consistent with your baseline outlook that you started the year with. Have there been surprises that affect the balance of risks that you just described?
Sure. No, that's a great question. So the first thing I'd say is, no, none of these pieces of information were surprising to me. They're well within the bounds of what normal volatility looks like, especially in what are turning points. All of you know, if you look back over history, I've been through this now a number of episodes, because you have a long career, you've seen a number of these episodes. The data around turning points in the economy, whether that's a turning point to expand rapidly or a turning point to slow to a more sustainable pace, they're always bumpy. It's just a fact. And so you really have to step back and look at them and say, is this normal bumpiness or is this outsized bumpiness? I don't see anything abnormal about what I'm seeing. And so it's another reason to just underline that piece of don't hang your hat on one piece of data. It's useful to look at the trends. And so what I'm seeing now is ongoing progress in inflation that's going to be moving around in terms of the monthly estimates, but the progress is still there. You're also seeing the labor market slow in some dimensions, but one number pick up, another one weaken. That's completely to be expected. And so my expectations for the economy are very much what I had in December when we released the SEP, and I think a baseline outlook that it says inflation is going to come down gradually. The labor market's going to slow gradually. Growth will slow, but nothing is going to be drastic or dramatic. And if that happens, we'll start to gradually normalize policy. That seems to me like a reasonable place to sit.
Still a good baseline.
Still a good baseline.
Okay, so the December baseline did feature, and that December baseline, you described this growing sense of optimism amongst firms and households, and some of that is based on that expectation that the Fed will be able to cut rates. So with that baseline, you've got 3 cuts in the baseline. I don't know if you're
I think that's a reasonable baseline.
Okay.
The median of the SEP seems a very reasonable baseline to me.
So as you move towards that, how do you communicate that to the public? What are you looking for to initiate that first cut?
Sure.
What do you need to see to have greater confidence that those inflation trends are durable?
Sure, absolutely. And I want to point out something, because that's a great question. But something that, one of the things we do as regional Fed presidents, all of you probably know this, is we spend a lot of time in our districts and across the country talking to businesses and community groups and worker groups. And And interestingly, when they are talking to me about this relief they're feeling, they're not talking about rate cuts. They're talking about the end of rate hikes. Right. And so they're not looking for rates to come. They're not asking me when we're going to think about cutting rates. They're asking me if I think this progress on inflation is really going to continue, because that's really where their problems are, is that inflation's high and they wanted to know if the rates were going to keep rising.
Right.
And so that's where that relief is. Now, when you think about how that translates into the economy and how we are communicating with people, I think what we need to continue to communicate is that it's premature to think about just letting the economy run, because they see inflation in their daily lives. And one young man who runs a small business came to me and he said, look, he calls me President Mary, but he said, look, President Mary, which I thought was very sweet. President Mary, he said, it's 3% on a higher price level. I think he said prices. Right. Is a lot more troubling than 2% on a lower price level.
Right. So
he said, don't give up. And I think that's the sentiment. So somewhere between don't give up on keeping inflation coming down and don't break the economy is where the average person I speak to sits.
Right.
And for them, they want us to make the right number of rate cuts so that that happens.
Right.
And if that's 2 or 3 or 4, they just want us to calibrate so that we hit that middle. And that's why these two risks of don't let inflation slow too little and don't break the labor market are so important. Does that make sense?
Yes, it does. And that means you have to be looking forward.
Absolutely.
So what are the forward-looking indicators you're relying on?
So this is where I do think that the work that all of us do, but the Fed this is our job. So we have models, we have history, we have data that are largely backward looking. There are some forward looking surveys. And then we have what I think is totally misnamed anecdotes. So let's strike anecdotes from our parlance. Unless you're talking to 6 people at the soccer game and you're going to go back and report that as your data, it's not an anecdote. It's qualitative surveillance or qualitative data collection. We have to talk to businesses, workers, consumers, et cetera, about what they think they're going to do in the next year. And so that's what we add to it. And so because you're right, if we made policy just waiting for the data to appear, well, then it's too late.
Right.
Because of the lags in monetary policy. You cannot wait. You have to look forward. So we have to ask businesses, what are you doing? Are you going to raise prices? Are you going to raise wages? By how much are you raising wages? Are you hiring more? What would change your plans? And when we do all of that and come together, that's where I get this sense that the elements of what happened last year are still there.
Okay.
But we have to see how much they play out by continually checking. Does that make sense?
Yes, it does. It does. And there's a few questions here, and I have this same question, which is the labor market. This year we're starting the year very solid, but not quite the red hot labor market we had at the start of last year. So that has cooled.
It has.
And when it cools, there's a question on the SOM rule, that it's at the state level. We have triggered it in certain states. And that when the labor market, when firms stop hiring and when you start to see layoffs, it tends to go in a nonlinear fashion. In other words, once you've seen job losses, it's too late.
That's the historical norm, that unemployment looks like this and then it looks like that.
Right. So how are you assessing, what are you hearing about the labor market bottoms up? What are you, the disciplined, not anecdotal gathering of ground level information? And how big a risk is that? Do you see that, we've been on this kind of cooling trend. We got a pop in January, but if we're on that cooling trend, we're getting closer and closer to that tipping point.
And I mentioned that this is something we have to look at. Now, the challenge that we always have is that the labor market is good until it's not. And so then you have to look at other things outside of it to say, what are the elements or the fundamentals in the economy that could slow it? So one of them is plans for hiring.
Right.
And so we ask a lot of questions about plans for hiring. And right now I'm hearing interesting things. At the tech sector, people say, oh, I'm not hiring as much if you're doing what I call core provision in tech. You're a core provider. But everybody who has been short of tech people, especially in cyber and other things, are using this to say, oh, thankfully, we can get somebody in tech now because we couldn't get them before. So I still think we have room in that chain because there's still pent up need that couldn't be filled because you couldn't find a technology worker in the hot technology labor market, and now you can find somebody. So that's still there. In consumer services, we do see a cooling, but a lot of the firms, like think of leisure and hospitality, they were really undersubscribed on their labor. And so now it just brings them back into balance. And what they're seeing is they can do less overtime and come back more into balance. And it was interesting. I was talking to someone who is in the labor, works for a union, and he said that the number one issue for his union members is not pay or health benefits. It's planned hours. They're working too much overtime. And they want to have planned hours. And on the other side of the equation, they don't want predictable schedules. That's what it was, predictable schedules. And I think that is where we could see, more hiring or different kinds of hiring still there, but hours coming down, overtime is going to be coming down. I think this is just about bringing an economy back into balance. So I haven't seen a sense that this is going to go like that. But one of the reasons you would begin to normalize policy in advance of hitting 2%. I get asked this, why would you ever reduce rates? Not in a room like this, but out in the world, why would you reduce rates before we hit 2%? And I said, well, there's lags in monetary policy, but the closer you get to those lags hitting, you can find this unexpected rise or fragility in the labor market. And then you've given people low inflation, but you've taken their jobs. And that's really not the dual mandate.
Right. So you're looking forward, you still see some decent momentum. It's not something that you're concerned about an imminent weakening.
I don't see an imminent weakening, but we have to be focused on it because the risks are balanced. And so I just want to recognize risks on both sides. Right.
And so on the inflation side, where you say, we're going to cut before you get to 2%. So again, and recent data hasn't, shaken your confidence that the trend is going in the right direction?
It has not. It has not shaken my confidence that we're going in the right directions. For me, it's not about are we going to go in the right direction? It's about how quickly are we going to go there.
Okay. And so if the Fed does have the good fortune of being able to initiate a sequence of cuts in the nominal funds rate alongside cooling inflation, how do you go about that? Is there a cadence you have in mind? How do you communicate that? Is there no forward guidance? How does the Fed think about that strategy?
It's a very important question. So back in November, I gave a speech on gradualism. And, the idea of gradualism that I first learned was from Ben Bernanke. He gave a speech in the 12th district back when I was a younger economist. And it was really when you face a lot of uncertainty, you take your time. And you don't go quickly. So my own expectation is in a world that's so uncertain, then we would not have the same loosening cycle that we had a tightening cycle. Because remember, the tightening cycle, that was rapid. One of the most rapid in history, right? We're there, we have to we're at zero, we need to be higher, and we raise rates quickly. But now we're in a much better place. Policy's where it needs to be, the economy's in a good place, and so we can look ahead, but we can take a more gradual approach to this. And gradual doesn't mean slow, it doesn't mean weak, it doesn't mean sleepy. It simply means not abrupt and urgently when you're facing a lot of uncertainty and you already have policy in a good place.
Right. So do you see the current level of the Fed funds rate as restrictive?
Yes.
So what about the destination? Do we have a sense of where the destination is?
So, this is an open question that that everybody wants or needs to have a view of. So I'll share my own view. All the remarks I make are my own, of course, but let me talk about how I think about it. So the neutral rate of interest, R star, is very hard to estimate. And at one point, this was some months back, probably almost a year back, I asked my team to bring me the range of models. There's a lot of models. And the estimates of R star went from -2 to 11%. So that tells you there's a large span. But here's what I've learned about the star variables. They don't try to estimate time varying star variables when you don't even measure the long run star variables well is somewhat of a fool's errand. So you have to learn experientially how tight things are. If you asked me today, which I think you are, what's your estimate of the longer run neutral rate? I think we came into the pandemic thinking it was about 0.5. If you took those estimates, 0.5 was right, then you had 2% inflation. That's a 2.5 nominal neutral. Now I see a reason that it could have gone up a little bit. So my ballpark is between 0.5 and 1. So that means a nominal neutral between 2.5 and 3. Okay. That's a starting point for me. Right. And then if you think of that as your starting point, you can figure out if you get better estimates as you go, but you also can figure it out by what you're seeing in the economy. Right. And I'm seeing the economy slowing, and I'm seeing a lot of the slowing in inflation that we've seen come from demand, not just supply. So that tells me policy is working and is having its intended effect. The transmission mechanism is not broken, and we just have to see how much longer it's going to take for us to get the job done. Okay, and how does balance sheet policy feed into this? So you're shrinking the balance sheet. That's a form of tightening. Chair Powell indicated you're going to get a sort of comprehensive briefing on the options for slowing that down at the March meeting. Is there kind of a process in mind, a sequencing? Do you think you're going to start that before you cut rates before you start that? Does it matter? How do you fit those two tools? You have two policy tools, well, three, including communication. Yeah. So how do those all work together? What are your thoughts on balance sheet policy from here? And I'll share how I think about it. So the first thing is, when we announced that we were going to begin normalization of our balance sheet, a lot of the effects of that get priced in automatically, because markets, if you look at markets, they just say, okay, this is what the plan is. They're going to get this down to ample. Ample's an unknown variable, but it's going to at least be this. And so that gets priced in. So I don't think of it as a flow variable. I think of that as priced in. So now the next question is that markets are asking, and everyone's asking, is what's ample? Yeah. And we don't want to hit the 2019 moment again. How do we get there? And so that's Chair Powell's addressing that by saying we're starting to think about those things, slowing it down. But one of the lessons I took out of feeling a little behind on raising interest rates when inflation was coming up was that the funds rate and even our forward guidance is like a speedboat. Yeah. We can adjust them very quickly. I see those as our funds rate as our primary tool. I see forward guidance as our next best tool. It's the two we've had the most experience with. The balance sheet, we have less experience, but it's also like a tanker ship, because it's not just, we can communicate the stance of policy with the balance sheet, and they should be aligned, right? That should be one stance of policy. But it takes longer to adjust things like purchases, the pace of purchases, the pace of runoff, because you also have markets to consider. You don't want to cause dislocations. So I don't see that we have to join them together mechanically, but I do see that we want to convey a single stance of policy. And the single stance of policy is we were tightening policy and have been tightening policy. That meant we were normalizing our balance sheet and raising the funds rate. Now we're to the point where the funds rate is restrictive. The balance sheet's been running off, but now we have this mechanical issue of we don't want to go past ample reserves and cause dislocation. So I don't see this as having to be so tied. Those are consistent in my mind. They convey a single policy stance, which is the economy still needs restrictive policy. How restrictive will be determined by the funds rate, and the balance sheet now is a decision about where's ample. Right. And ample, there's some sense that after last year, with one thing we learned last year was how quickly deposits can leave a banking institution, and that leads banks to want to increase that level of reserves. Exactly. Is that one reason for being sort of proactively planning that process of slowing it down? Well, I think we proactively planned that process as we did the last time. We had a proactively planned program, but ample came faster because banks wanted more reserves than they were saying even that they wanted, if you remember back in that period. And I think now we just realize banks might want them. and we have to be thoughtful about what they're going to hold on to,
Right.
and then plan accordingly.
Okay.
And I do think that we're on the path to do that, and that this is really about making sure that we don't hit that ample. We do have facilities now, though, that really help us out in this transition. So I'm not expecting disruptions, obviously,
Right.
but it is appropriate in my judgment to plan for this in March, as the
Okay.
chair indicated.
Okay. All right. So I'm going to shift to from the very near term and kind of where we've just been to some like deeper questions about what we're learning.
Deeper than our star?
Deeper than I know. It doesn't get much deeper than that.
I
Doesn't
know.
get much deeper than that. But productivity, you mentioned productivity. It was the, large scale surprise last year, 2.7% non-farm productivity growth. That's well above trend, as you noted. How do you understand that? Is that mainly just normalizing post-pandemic? Is it a feature of a labor market that saw better matching through quit rates? Run it hot labor market gave us higher productivity. Is it something that's more structural and sticky? Is it AI driven? How are you understanding these productivity?
Well, I think you've nicely laid out all the possible things that could go there. So here's how I think about it. And, I had the benefit of starting at the Fed in the mid 1990s, 1996. And that was right when Chairman Greenspan was looking at all the details, trying to figure out if we were having some sort of a productivity boom, when none of the statistics show that we were having a productivity boom, but it was confusing why the labor market could be so strong.
GDP growth still 5%?
Exactly. And inflation wasn't taking off. And so I took a lot from that you can miss productivity improvements even if they were happening right in front of you. And the way you have to think about this is to go out and ask people, what are you doing? So let me just talk about what we've learned. So tight labor market does result in better matching with the quit rates, but it also results in firms saying, I need to make investments in technology because the future of the labor market is just going to be tighter. That's what they came away with. And so they started making investments. So AI, not Gen AI has been around for a long time. So we have kiosks that you can order from. But the number of firms that invested in those types of things to do jobs that they normally or typically would have had people doing, when people were short supply, they invested in those things. So you see that now, and it's not just everybody always thinks I'm just in the West Coast, and so it's all the West Coast thing. It's not the West Coast thing. It's everywhere. You go places, you're checking into your hotels, you don't have to talk to a person. You can order food, you can go, get somebody to deliver it. A robot can deliver your things at some points, right? So I was in a hotel in Las Vegas. I just needed they forgot to put soap in the hotel, and here comes the robot with the soap. And so these are investments that companies or firms don't make until they know that the ROI is going to be high enough. And one of the things that makes the ROI high enough is the cost go down. Well, that didn't happen this time. What happened is the shortage of workers made it worth their investment in spending it on the fixed costs. So that is already happening, and those investments have been made over the last couple of years. That bodes well for productivity growth, right? Because they're still learning how to use all that technology and harness it, but they made those investments. I think the other thing that we're seeing is that the workers themselves are coming back, and they absolutely want to learn and grow. And we're seeing more divisible education. And that's going to increase productivity. For the longest time, we've been worried about labor quality. And what I'm seeing now is firms taking it on themselves to say, we need you to do this. You used to do that, and we're going to put you through a certificate program or send you to LinkedIn Learning or do whatever we can to get you skilled up. But divisible learning means you can scale the labor force's skill level faster and more agilely than you could before. So I think there's room to be optimistic, but I want to see more evidence. I want to put my Chairman Greenspan hat on and go and pore over the numbers and ask more questions, tour some factories, see how they're using it. But I'm optimistic. I'm just not confident that it's going to happen yet.
Right. That's where I came at the Fed at the same time. I had the same experience, and it was an interesting time, right?
And it does teach us.
We can't have good things.
We can't have good things, and it also teaches us that the data are really helpful.
Yes.
We have to look at the data, but you also have to ask questions,
right?
Because you can miss things, because the productivity statistics are going to lag. the insights you can learn from just going
Watching
to
the
factories and
data.
touring.
Yeah. Yep. And so that's fantastic. I like the optimism, the cautious optimism.
Cautious, yes.
Now let's talk about inflation dynamics. Like nobody on the FOMC expected to have inflation where we are right now, according to the SEP. So at this time, sometime in the future, they expected it.
Right, no, absolutely.
So what are we learning? There was a notion that the last leg of inflation is the hardest.
I don't agree with that.
You're not
premise.
in that camp.
I'm not in the camp of the last leg's the hardest. I mean, that suggests that we have to grind out the last 0.2 of a percentage point on inflation just laboriously. And I don't see evidence that that's true.
Okay.
I see that as the labor market and the inflation risks come into better balance, that we have to be more thoughtful about how we get there. But I don't buy into this idea that it's going to be so much harder. If it is, we'll be prepared for it, but I don't think we should expect that. I think we should expect, and I also don't buy into the idea that it's all going to be super easy. So somewhere in between the great normalization, which I call immaculate disinflation,
Right.
and it's going to be a grind, and we're never going to get there unless we break the economy, probably lies where we're going to be,
Right.
where we're somewhere in the middle. But it's going to take careful calibration and
Right.
a lot of thoughtfulness to do that well.
Okay. So
Didn't mean to jump in, but I don't like that last mile is the hardest.
I love the passion.
Commentary. I know I'm hardly passionate
love
about
the passion.
these things.
Well, you're in a room of kindred spirits here, so we appreciate that. It also came, the disinflation has come without labor market pain. And you mentioned sort of the steep part of the beverage curve, et cetera. What about the supply side? Is there going to be a more expansive approach to thinking about the inflation outlook at the Fed, where we're not just thinking about the labor market, we're thinking about the structure of industry and...
I think personally, let me talk about myself for a moment. I've always thought of it that way.
Okay.
I mean, supply and demand join together and prices come out, right? So you've got to look at both sides of the equation. And we got a big positive supply shock from just globalization, right?
Mm-hmm.
Automation has historically given us positive supply. Right? Productivity growth. So you put all those things together, that allows the economy to grow rapidly without spurring inflation.
Right.
Most of my career has been in that period.
Uh-huh.
And so I'm very bullish on that can happen.
Okay.
But what is happening now is we've got all this high inflation that was post-pandemic, and I don't think we expected, I know I didn't expect, the productivity and labor supply response. I never count out American workers, I really don't. I've been abused about this so many times in cycles because I always think they're going to come back. And they did, but I didn't expect how fast they would come back.
Yeah.
I thought it would take a little bit longer.
Okay.
And then productivity growth, I was surprised about. It would bounce back so rapidly.
Right.
Those are two good supply boosts.
Yes.
The question is, how much more do we have out of those?
Right. And then the third element, of course, is inflation expectations,
which are well anchored.
Which are well anchored. Yes.
I mean, then I'm very passionate, right?
Yeah.
Because the long run always were well anchored.
Yes.
They stayed very well anchored, but short run, which always fluctuate more, those are somewhat more worrisome because short run inflation expectations, based on some work that they did in San Francisco, and I was really influenced by, those are feeding right into wage negotiations. And so getting those short run inflation expectations to come back down and people feeling more comfortable in that space just creates a positive dynamic that I think also helps us. If we can get consumers, which is what's happening, to do part of the work of bridling inflation, that is a very good thing.
By becoming more price sensitive, you're saying?
Yes. When they go into the retail outlets and say, no, where's my
bargain,
discount?
Everybody bargain.
You're hearing that. Our firms are telling us that price sensitivity is very much higher now, and that they might have the same posted price, but consumers don't want to purchase it unless they're seeing a 10% discount, or, how many of those Amazon days are you getting where this is discounted and all that? I mean, this is a serious improvement in the role that consumers play in bridling inflation.
So, and Mario Draghi spoke to us yesterday, and he was talking about making the point that, and this is a question somebody submitted, which is an excellent question, that in a world where fiscal policy is more expansionary, that the role of inflation expectations is all the more important, and that the central bankers need to be very focused on that. Do we have the right measures of inflation expectations?
You know, I think we have really good information on inflation expectations. We have surveys of consumers. You know, we have the Michigan, we've always had the New York Fed now. That survey is quite helpful as a augmenting feature. Then we have business surveys, many of them. Then we have financial markets. You can use various measures. And I don't think you can hang on to any one of them and say, okay, that's the thing. Mm-hmm. But seeing how all of them are responding relative to their own norms. Right. This is all about deviations from the normal pattern. Right. Because you can't really look at levels in these, at least in my judgment, you can't look at levels of these things. You have to look at deviations from their norms, which is why I kept saying norms. Yeah. Because I do think that's how you view these. If you look through that landscape, or that lens rather, you can see general movement of these patterns in a way that has correlated with the economic dynamics we've seen. So we can always use more data. So if you want to have an inflation expectation series, go to it. I think that is always better, but it's really the collage of evidence that we put together. And I do think we have a lot of good insight into that. There's also this really, I haven't checked recently if they're updating it, but there was this really cool survey or piece of information that BLS did where they looked at the frequency and magnitude of price changes. Yes. That is a very important part of the data set, because it's telling you not only what people expect, but what firms are doing. Right. Yes. Nice. Excellent. That's very helpful. A very rich discussion. So we've done labor market, we've done inflation. How about lags in policy, monetary policy transmission? Are the lags longer? Are they shorter? What are we learning from this cycle about lags in policy? So this is how I think about it, that there's two components to the lags in monetary policy. One is the transmission of what the policy stance is and the path into financial markets. And the second is financial markets into the economy. When I look at the data, the path from the stance from stance to path to policy to financial markets, that's almost instantaneous now. And you can see that by looking back in November of 22, I'm losing track, 21. When you started? When we started. Yes. It was Thanksgiving. It was Thanksgiving, November of 21. That's right. The years are blending. I don't know. In November of 21, it was Thanksgiving, and we, around Thanksgiving, and we said we were probably going to taper asset purchases faster, and the mortgage interest rate rose immediately. Right. Because everyone knew that meant we're going to raise rates as soon as we get that done, and sure enough, all that priced in. So that's immediate. Right. But then it takes about the same time it's been taking to walk through the economy. The same thing is true now. Everybody understands that it's most likely that we are completed with our tightening cycle, but that it's uncertain when we will begin to start cutting rates. And you see markets have moved around quite a bit. They go up on every data point. But in general, what you're seeing is that the mortgage interest rate's not continuing to rise. It's even come down a little bit, right? People are starting to see revitalizations at lower interest rates. I was talking to a CRE roundtable, and they're ready to, they're back to doing deals and things because they say, okay, now we're in a different environment. So I think that transmission is immediate, but it takes a time still to go through the economy, which is why we can't wait to get to 2% before we do a policy adjustment. That would be not good. And that's excellent. And you touched on CRE. That seems to be one of the lagging things that's still feeding through, right? Where are we on that process? How big a risk to financial stability is that? So we knew that it was going to be coming in this year. I mean, you just look at the contracts, where most of the contracts are the loans are repricing. So they're usually 3-year loans. They knew the tightening cycle was coming. They locked in the low interest rate. Now the refinance is coming. And so, I don't right now, and we do all the quantitative surveillance on this from, our financial stability report, release it to the public twice a year, but we talk about it regularly. I don't see this being an imminent risk to financial stability.
Okay.
But you might ask, well, why? Well, let's walk through CRE. CRE is many things. It is industrial, it's warehousing, it's multifamily, it's commercial office properties, office buildings, retail space. So industrial and warehousing, there's not much weakness in that sector. In fact, it's strong in most places. Retail, let's think of retail. Retail depends on where you are. If you're in downtown San Francisco, retail is not great. If you're in the suburbs of the Bay Area, retail is booming. They're building more retail space. So you can't think of retail without thinking of the location of the retail. Some pockets are weak, many pockets are strong. Same with office buildings. Class A office buildings in even downtown San Francisco, those are fine. And Class C are okay, because Class C is doctors, lawyers, title insurance companies, lots of things that do in-person services. If you've got Class B space and you got a lot of it, you're going to be in for a repricing. But commercial real estate owners already know this, and they've triaged. Here's the ones they call it take to ground. They don't mean tear it down, they just mean shut the lights off and wait for things to get better. And then there's other ones they'll sell. And in this commercial real estate group, I heard that we had private equity firms in too, and they're waiting for the price points to get right. So there's a natural floor underneath these things of when the price gets low enough, if there's a sale of properties, there are investors wanting to come in because a lot of the weakness is in big downtown cities, right? San Francisco, Seattle, some in Boston, Austin. But these are desirable places to live. And if you've got enough to buy them and last through.
So the land retains a value.
The land retains a value. The location, the city itself has an energy and a value, but it just takes a long time to work through. So right now, I'm not seeing imminent risks, but we are going to have corrective actions. There's no doubt about that.
And will that be something that is a restraining factor through the banking system? Is that just the way policy works?
Well, policy does work with you raise interest rates, and certain loans that were profitable and lower interest rates, or certain ideas, properties, innovations that were desirable at 0 to 1%, aren't quite as penciling out at 3 to 5%. And I think that is just something that happens when interest rates rise. So what real estate owners who I talk to are really thinking about is what's the long-term path for interest rates. Because ultimately, something penciling out, is it short-term, you have to figure out how to do it and which kind of bank can work with you to restructure, or is the interest rate path or the level of interest rates just going to be higher for a long time because things have changed in the economy and we're not going back to the low interest rate environment that they thought this project worked at, and they don't want to have that project anymore. And I think that's what we're going to learn more about in 2024. But this is definitely a risk to watch. It's just not one that right now. So it really, I'm going to put it in two, these are simplistic, but you could have there's going to be restructuring, reordering. So is that going to be orderly or disorderly? And there's a lot of evidence right now that we could have orderly. Doesn't mean it's not hard. It just means it's orderly. Disorderly is the one where you get an abrupt change in things, but I just don't, right now I don't see evidence for that. And I actually don't have a lot of fear, even in the 12th district, that that's going to happen among real estate owners.
Because you've got some of the hardest hits.
I've got some of the hardest hits, and they're the folks who say, look, we're going to lose money. We're going to have to take these to ground. We may have to sell these off. My company will lose value, but I'm not going to go under. That's orderly. I hear a lot of that kind of thinking in Austin as well. So we are now out of time. It was a joy to talk to you today. Likewise.
Thank you for being with us. Please join me in thanking